The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit futuremoneytrends.com/gold.
Trends. I'm Kenneth Amaduri, and I'm joined today with John Kaiser of Kaiser Research, and we're just going to talk about the economy today. We're here at the Silver Summit 2015. John, thanks for joining me today.
Kenneth, thanks for having me here.
You know what? What's on my mind right now is the fact that precious metals are so low, and there seems to be such a disconnect between the economy, stock prices, precious metals, and for that matter, the mining share prices. So, first of all, let's talk about the economy real quick. Is there a major disconnect with what the government wants us to believe and what's actually going on with the stock market?
Well, if you're looking at things in the resource sector has been hammered. You have companies like Teck Resources, world-class mining company, from $80 a few years ago down to $6. That type of decline, that's like a penny stock decline. So you're wondering, how can all these mining companies have such incredibly low valuations if the economy is so strong that they need to start raising the interest rates? With regard to gold, that's a different matter. Gold has no proper function in the world, and it has been promoted as a hedge against fiat currency debasement and against hyperinflation. And if you're a U.S. resident, well, your dollar is now higher than all these other currencies out there. And of course, there is no hyperinflation. There's a 0.04 negative inflation year over year reported in the past month. So all those reasons for owning gold have not materialized. So there is a backlash. There's this expectation that, gold is still overpriced here. And so at these gold prices where we are, 1,100, between 1,000 and 1,100, a lot of mines are not profitable. There is not a good profit margin. So no, there is not a disconnect between the prices of the equities and the price of the gold. Maybe there's a disconnect as to where gold should be, but that's another question.
Okay. Well, my thought is this. The Fed has printed a ton of money. There's a lot more money out there, which is the definition of inflation. It's the expansion of the money supply. So what's your thought on that? With low interest rate, we got a record low interest rate. Companies are purchasing their own shares left and right. And quite frankly, it seems like the Fed is out of ammo in terms of being able to raise rates or do anything at this point, because we're on the verge of potentially the next recession. We've 7-year bull market in the stocks. The economy has gotten better according to the government numbers. So what are your thoughts? What is the Fed going to do, and will that translate into what could happen to gold and silver?
Okay, a number of facts that people generally aren't aware of. Yes, there has been record money printing. M2 money supply is at an all-time high. However, the velocity of money, which is the degree that money exchanges hands, is at an all-time record. It is when the velocity of money increases, that's when you get inflation. On another measure, the current M2 is still well above where it was for the last 2 decades as a percentage of the gold stock. So the gold stock, the 5.4 billion ounces that exist, it has gone from $400 level to as high as $1,900. It's now parked around $1,050 to $1,100. The value of that gold stock relative to this newly high money supply is still at a very elevated level. So you can't argue that as a consequence of all this money that's been printed, that gold price should be higher. It doesn't need to be higher. What we need is the velocity of money to increase. And perversely, the raising of interest rates will actually accommodate that, because much of the money printing that took place in the last 5 years in a very low interest environment it really went to take off the poisonous, toxic assets that Wall Street had created during the prior decade until the 2008 financial crisis. And those assets were generally held by established wealth. And so the wealth of the world that had become to some degree hollow has simply been made whole again. But when you have just the economic elite be wealthy, the wealth effect is quite minimal. A wealthy person doesn't need to spend an extraordinarily more money than they already have. So the kind of inflation pressures you would have thought did not materialize. The ordinary consumer has been flatlining for the last 5 years. And the banks have not been willing to lend to the ordinary consumer because their margin on the loan is very low relative to the default risk. So we have not had a proper real estate-based credit expansion. And what this causes is businesses to see, well, there's no consumption growth. We have secular stagnation. So we've had this negative spiral or frozenness. This is why companies are using their capital to buy back their shares and just prop up the asset values rather than investing in the future. And I think by raising the rates, even though it risks making things worse for the rest of the world temporarily, it is designed to put a light back at the end of the American tunnel so that this country gets shaken out of its end times mentality in which it seems to be trapped. And in my view, all of that is good for gold, because if we get back on a prosperity-based, broad-based prosperity uptrend with the United States leading the charge, then we will see demand for gold pick up and price it perhaps into the 1600 range, where I think it should be right now. And that's a real price range, not just some inflation adjusted range, which is not good for any of the producers, senior, juniors, or even the ones that are sitting on deposits that just don't make sense developing at the current gold price.
In our most recent interview that you did with my partner, Daniel, you gave a pretty big endorsement for Nevada Exploration, and I just wanted to see if you had an update for us on this company.
Well, I believe that in this current environment where macroeconomic trends are not going to push up raw material prices for a couple of years because there is an oversupply due to the big mining response to the China supercycle that has now run its course. It's going to take a couple of years to unwind that. It's going to take a while for global growth to get back on track properly. So the main driver for gold price higher is also absent. So I see an environment of stagnant metal prices for the next couple of years. So what do? Do you just go hibernate? Or do you do what happened in the 80s and 90s? You start exploring for precious metals, for base metals, for raw materials. You look for something that works at the current metal prices that we have. And so what I look for are companies with talented management, geological ideas, the ability to go in and rethink an area, put it into a company, show us what the potential is, and raise risk capital and give us 5, 10, 20 baggers. And Nevada Exploration Inc. is this type of company. They've spent 10 years collecting groundwater samples in Nevada. Nevada is the best gold field in the world. Less than a third of its potential has been found because of the fact that it's a very complex underlying geology, but also because half of it is covered in gravel. And I think when we last had the interview, they had not yet announced that Grass Valley, a project for which we had very high hopes a couple of years ago, but had been killed because McEwen Mining drilled one hole and managed to hit an uplifted block of upper plate rock that there's no chance of carrying any gold. Everybody assumed that the gold in groundwater anomaly was just a mirage, that this was a hopeless bedrock underneath. Well, they reported results from some geothermal holes that had been drilled about 8 to 10 years ago, which aren't in the right place, but they're close enough to it, and it revealed that there are elevated toxics and anomalous gold in the surrounding bedrock, which means that this groundwater anomaly is alive again, and that this play, which the market had thought doomed, which is within 15 to 20 kilometers of Cortez Hills and never been properly assessed because it's completely blind, it is back in action.
So one aspect that we haven't really touched on yet is the supply demand. And at these prices, a lot of these companies aren't profitable. And do you see a supply issue in the near future that can cause the price of gold and silver and some of these other metals to go up. I mean, silver's a byproduct primarily, and we got these base metals absolutely collapsing. So could this be the black swan or a major event that causes the price of the metals to take off and do what everyone's wanting them to do?
Okay, well, first we have to distinguish the types of companies. The one we were just talking about, discovery exploration, they have no assets of any discernible reality. They are exploration plays. They have potential to find a major gold deposit or copper deposit or whatever. So what the gold price or what the supply and demand of metals is at the moment is irrelevant to these companies, which is why I'm sort of enthusiastic about now as a speculation. But it's the ounce and pound in the ground companies which spent tens of millions of dollars over the last decade taking existing deposits found decades ago and discarded because they just weren't good enough at the metal prices back then. And when the China supercycle drove up metal prices 4 or 5 times in nominal terms, which also included real price gains, all of a sudden these deposits were in the money. The juniors dredged them up, raised money, did feasibility demonstration work. But in the meantime, the price of metals has gone down 50% from the peaks where they are. Copper's pushing on the $2 on the downside. Gold's, at 10.50 or so. Silver's back to $14 after assaulting the $50 range. These projects are now worth zero. And the big question is, the metal prices that we have now, are they here to stay? I think no, because at these levels, too many even operating mines are marginal, and they are being shut down as a result of these low prices. Now, why do we have these low prices? Well, in the last decade, part of the big promotion was, we got hyperinflation coming. You need to own hard assets like metals. So metals became financialized. We have right now the gold or the platinum ETF undergoing major withdrawals because suddenly, we have the Volkswagen diesel scandal and concern that platinum demand is going to disappear. So we have suddenly a flood of metal coming into the market, a flood out of China, where metals were used as collateral for speculating on the Chinese stock market bubble and all their real estate bubbles. All of this is coming unglued. We have a temporary washout of financialized metal, and the end users are sitting back and saying, well, we only need so much per year, and we don't catch falling knives and anvils, so we're standing back to see how low this gets, and if it gets incredibly low, we will buy it. But this is of a temporary nature. This is not a permanent change in supply demand. And that's why I think once we make it through this year end where all these accounts have to be squared and that, we are going to be in a much better environment. We will see metal prices recover from these current lows. And then we still have to wait for the macroeconomics to kick in. But I would say watch for the interim stresses to cause supply disruptions in places like Congo, countries that are being enormously stressed by the decline in raw material related revenues, oil producing countries. When these countries undergo structural collapse, they will not be back in action for a long time. So we may get some joy on the price side coming not so much from demand bursts in the next while, but from supply disruptions caused by geopolitical stress. And this geopolitically stressed environment we're moving into with Putin sort of pushing in Europe, with the Middle East threatening to completely disintegrate, with China trying to claim the South China Sea and America trying to push back and saying you can't do this. All of these are potentially very geopolitically disruptive trends, and that could even make gold go to $1,500, $2,000 out of a geopolitical shock, and that's good for the industry because that has nothing to do with the costs of production as inflation does.
John, so final thought. I heard David Morgan say this. He said, I'd rather be 6 months too early than 1 minute too late. So, and just your final thoughts, what does a bull market look like? Is it going to be something that just takes off just sporadically, really fast, where people are going to have an opportunity to ride it up? Or is it going to be really take off without the opportunity for people to get in? Is now the time for people to acquire to be ahead of what could potentially be a really fast move?
Well, I would look at it from the point of view of watching a pan full of popcorn. When you start that going, you've got a bunch of very dead kernels sitting there doing nothing. And that's what it's going to look like in January as we enter into the new year. Now, you know that one kernel pops now, nothing happens, then another one, then maybe a few more. A bull market looks like when that whole pan has just got popcorn welling out of it and bouncing around. We are quite a ways away from that. But you don't make money during that part of the popcorn, all the kernels popping. You make money being in there during that early stage, happening to pick that kernel that pops earlier, and then the ones that pop next. That is how you make money in a resource sector type bull market. That's why this is what they call going to be a selective market. It will take several years for a bull market conditions to reappear. But those several years could be the most lucrative time for people who have the guts to take a look at this sector.
I've never heard that analogy, and it's an excellent one, and I'll give you the credit if I ever use it. So, John Kaiser of Kaiser Research, thanks so much for taking the time
Kenneth,
with me today.
thank you.